To continue talking about this region. As we have been reporting today, China has now raised interest rates for the third time since October. And emerging market stocks continue to lose ground as investors worry about slower growth in the Chinese economy. Our next guest recently wrote that it's time for shareholders to, quote, repatriate some of those emerging market assets. Mark Luschini is chief investment strategist at Janney Montgomery Scott, where he oversees more than $50 billion in assets. So, Mark, it's a very interesting, thought-provoking title, your last piece entitled Repatriate Some of Those Emerging Market Assets. What do you mean by that? What's the point?
This has been something that we've been toying with for some time in terms of analyzing these different equity markets around the world, understanding, of course, the allure of emerging markets being the fact that their growth rates are so phenomenal when compared to advanced countries like the United States. But along the way, of course, equity prices have been bid up to the point where valuations in the emerging markets in the aggregate today are about even with, in fact, in the aggregate, maybe even slightly over that of the U.S. market. And within the U.S. market, not only do we find valuations in U.S. equities relatively undemanding, but in particular, those large-cap multinational U.S.-based companies that are selling even further at a discount to not only the U.S. market, but also to emerging markets and offering, in many cases, similar growth profiles in terms of earnings expectations.
So, Mark, your preferred way of playing it at this point, I mean, you don't deny, like most people don't, that the growth is obviously in the emerging economies longer term, but the way to do it now is to maybe check out some of those U.S. multinationals.
We think so. I mean, from a secular standpoint, we're clearly bullish in emerging markets over the long run. But on a near-term basis, some of the things that you were talking about earlier in terms of not only the Chinese raising interest rates and reserve requirements in their banks to try to stem inflation and or property speculation is also being shared today among other emerging market countries. In fact, 50% of emerging market central banks today are in an interest rate raising mode. And as a consequence, they're trying to tamp down their economic activity to fend off the prospects of inflation, albeit inflation that might be somewhat transitory. But in the meantime, we think perhaps a better valuation and more secure way with an improving fundamental underpinning to our economy in the U.S. is to tap into that emerging market growth through U.S.-based multinationals.
Mark, let me ask you, is it just a valuation call, or is it also that you're worried about bubbles there? I know you mentioned the property sector, but is it that you're worried about even something greater that could happen in some of these emerging economies?
I do think emerging markets were taking on bubble-esque qualities. We saw fund flows in emerging markets, of course, being parabolic over the last couple of years. It's only in the last week, in fact, that you saw outflows from emerging market funds, which was the first time that occurred in 3 years. But nonetheless, I think it has the budding prospects of turning into a bubble situation, and one in which you're always some risk of being too early in leaving, but nonetheless maybe safer for having done so, and still equitizing those monies by committing them back into U.S. equities, which are more transparent and I think cheaper on a valuation basis and still offer an attractive growth profile.
Mark, you think U.S. multinationals, though, would take also a very tough hit if a bubble burst in China?
Well, certainly there'll be reverberations on a global basis because China is viewed as the world's engine of growth these days, for better or for worse. So I can't help but think that certainly U.S. equities would be vulnerable to some kind of a setback. In fact, we suggest today that given the euphoria that has been bid up in equity markets literally around the world, but even particularly here in the United States, that we're certainly ripe for some type of near-term correction, although one that we expect to be temporary and, in fact, quite healthy for equities to build upon a more substantive foundation upon which it can advance out through the rest of 2011.
Mark, got 30 seconds here, so be specific for us. What emerging markets do you suggest investors should back away from? What should they maybe still keep some exposure to, just quickly?
China would be one that we find attractive on a valuation basis, but would let this inflationary scenario play out somewhat. I think what is more interesting is some of the emerging market interior Asia countries like the Koreas of the world, like the Thailands of the world that look very cheap. In addition to that, from a longer-term perspective, I think Africa is very interesting since it's a resource-laden country that is servicing the global needs of infrastructure build-outs to China and in other growing economies around the world.
All right, good to get some time. Hey, Mark, thank you so much. Mark Luschini, he's Chief Investment Strategist at Janney Montgomery Scott.